1. Which of the following is true of closed-end schemes? A. Units can be bought and sold only on a stock exchange. B. Units can be redeemed with the fund at any time. C. NAV is published daily. D. They cannot invest in equities. Answer. The statement that is true of closed-end schemes is A. Units can be bought and sold only on a stock exchange. Explanation. Closed-end schemes, after the initial new fund offer, NFO, closed-end mutual funds do not allow new investments or direct redemptions. Instead, investors can only buy or sell units on stock exchanges, where the units trade at market prices. This means that liquidity is provided through secondary market trading rather than through direct redemption with the fund. Other options. B. Units can be redeemed with the fund at any time. This is false. Units cannot be redeemed directly with the fund until maturity. C. NAV is published daily. While NAVs are typically published daily, this is not a unique characteristic of closed-end funds. D. They cannot invest in equities. This is incorrect, as closed-end funds can invest in both equities and debt instruments. Therefore, the correct answer is A. Units can be bought and sold only on a stock exchange. 2. The NAV of a mutual fund is calculated as A. Total assets minus total liabilities divided by units outstanding. B. Total assets plus liabilities divided by units outstanding. C. Total investments divided by unit capital. D. None of the above. Answer. The NAV of a mutual fund is calculated as A. Total assets minus total liabilities divided by units outstanding. Explanation. NAV calculation. The net asset value, NAV, represents the per unit value of the mutual fund and is calculated using the formula NAV equals total assets minus total liabilities, divided by units outstanding. This formula ensures that the NAV reflects the true value of the fund's assets available to investors after accounting for any liabilities. It is typically calculated at the end of each trading day. Therefore, the correct answer is A. Total assets minus total liabilities divided by units outstanding. 3. Which of the following is a feature of a debt fund? A. High risk and high return potential. B. Investments in short-term securities only. C. Primarily invests in bonds, government securities, and other fixed-income instruments. D. Focuses exclusively on equity markets. Answer. The feature of a debt fund is C. Primarily invests in bonds, government securities, and other fixed-income instruments. Explanation. Debt funds. These mutual funds primarily allocate their investments to fixed-income securities such as corporate bonds, government bonds, treasury bills, and other debt instruments. The main objective of debt funds is to provide investors with stable returns and capital preservation through regular interest payments from these securities. Other options. A. High risk and high return potential. This is more characteristic of equity funds, not debt funds, which are generally considered lower risk. B. Investments in short-term securities only. While some debt funds may focus on short-term securities, like liquid funds, debt funds can also invest in long-term securities. D. Focuses exclusively on equity markets. This is incorrect, as debt funds do not invest in equities. Therefore, the correct answer is C. Primarily invests in bonds, government securities, and other fixed-income instruments. 4. For an open-end mutual fund, the NAV must be calculated A. Daily. B. Weekly. C. Monthly. D. Quarterly. Answer. For an open-end mutual fund, the NAV must be calculated A. Daily. Explanation. NAV calculation frequency. Open-end mutual funds are required to calculate their net asset value, NAV, on a daily basis. This calculation typically occurs at the end of each trading day after the market closes, reflecting the current market value of the fund's assets minus its liabilities. The NAV is then published and made available to investors, allowing them to buy or sell units based on this updated value. Therefore, the correct answer is A. Daily. 5. Which of the following fees is charged when an investor exits a mutual fund scheme? A. Entry load. B. Exit load. C. Redemption fee. D. Management fee. Answer. The fee charged when an investor exits a mutual fund scheme is B. Exit load. Explanation. Exit load. This is a fee imposed by mutual funds when investors redeem their units before a specified period. The exit load is typically calculated as a percentage of the redemption amount and is designed to discourage premature withdrawals, promoting stability within the fund. It is commonly found in open-end mutual funds and varies depending on the fund's policy and the duration of the investment. Other options. A. Entry load. This fee is charged when an investor buys into a mutual fund, not when exiting. C. Redemption fee. While similar, this term can sometimes refer to fees associated with early redemptions but is generally considered synonymous with exit load in many contexts. D. Management fee. This is a recurring fee charged by the fund for managing the investments, not specifically related to exiting. Therefore, the correct answer is B. Exit load. 6. What is the main objective of an ELSS fund? A. Provide capital protection. B. Generate fixed income. C. Offer tax savings and long-term growth. D. Provide regular dividends. Answer. The main objective of an ELSS, equity-linked savings scheme, fund is C. Offer tax savings and long-term growth. Explanation. Tax savings, ELSS funds provide tax benefits under Section 80C of the Income Tax Act, allowing investors to claim deductions on investments up to 1.5 lakh rupees per financial year. This makes them a popular choice for individuals looking to reduce their taxable income. Long-term growth. These funds primarily invest in equities and equity-related instruments, aiming for capital appreciation over the long term. The combination of tax savings and the potential for significant growth makes ELSS funds an attractive investment option for long-term financial goals. Thus, the correct answer is C. Offer tax savings and long-term growth. 7. Which of the following is not a characteristic of money market funds? A. High liquidity. B. Short-term investments. C. High returns with high risk. D. Investments in treasury bills and commercial paper. Answer. The statement that is not a characteristic of money market funds is C. High returns with high risk. Explanation. Money market funds. These funds are designed to invest in short-term, high-quality debt instruments such as treasury bills and commercial paper. They are known for their high liquidity, short-term investments, and low risk, which typically results in lower returns compared to other investment vehicles like equity funds. Money market funds focus on preserving capital and providing stable, albeit modest, returns rather than high returns with high risk. Other options. A. High liquidity, true, as money market funds allow easy access to funds. B. Short-term investments, true, since they invest in securities with maturities of 1 year or less. D. Investments in treasury bills and commercial paper, true, as these are common instruments in money market funds. Therefore, the correct answer is C. High returns with high risk. 8. A mutual fund portfolio's value will decrease if A. NAV increases. B. NAV remains constant. C. Market value of securities decreases. D. Market value of securities increases. Answer. A mutual fund portfolio's value will decrease if C. Market value of securities decreases. Explanation. Portfolio value. The value of a mutual fund portfolio is directly tied to the market value of the securities it holds. If the market value of these securities decreases, the overall value of the portfolio will also decline. This is reflected in a lower net asset value, NAV, for the fund. Other options. A. NAV increases. This would indicate an increase in the portfolio's value. B. NAV remains constant. This means there is no change in the portfolio's value. D. Market value of securities increases. This would lead to an increase in the portfolio's value. Therefore, the correct answer is C. Market value of securities decreases. 9. Mutual fund schemes with higher exposure to equities are best suited for A. Short-term investment goals. B. Long-term wealth creation. C. Fixed income. D. Risk-averse investors. Answer. Mutual fund schemes with higher exposure to equities are best suited for B. Long-term wealth creation. Explanation. Equity exposure. Funds that invest primarily in equities are designed to capitalize on the growth potential of the stock market over time. They are generally more volatile in the short term but have historically provided higher returns over longer investment horizons. This makes them ideal for investors seeking to build wealth gradually, particularly for long-term goals such as retirement or significant future expenses. Other options. A. Short-term investment goals. Equity funds are not typically suitable for short-term investments due to their volatility. C. Fixed income. Equity funds do not focus on fixed income, they are equity-oriented. D. Risk-averse investors. Investors with a low risk tolerance may prefer debt funds or other lower-risk investments instead of equity funds. Thus, the correct answer is B. Long-term wealth creation. 10. Which of the following is a primary role of the asset management company, AMC? A. Safekeeping of assets. B. Management of investments. C. Appointment of trustees. D. Regulation of mutual funds. Answer. The primary role of the asset management company, AMC, is B. Management of investments. Explanation. Investment management, AMCs are responsible for making investment decisions on behalf of the mutual funds they manage. This includes selecting appropriate securities, monitoring market conditions, and adjusting the portfolio to align with the fund's investment objectives. Their expertise in managing investments is crucial for optimizing returns for investors. Other options. A. Safekeeping of assets. This is typically the role of a custodian, not the AMC. C. Appointment of trustees. While AMCs may work with trustees, this is not their primary role. D. Regulation of mutual funds. Regulation is overseen by financial authorities, not the AMCs themselves. Therefore, the correct answer is B. Management of investments. 11. What does the term systematic investment plan, SIP, refer to? A. One-time investment in a mutual fund. B. Investing a fixed amount periodically in a mutual fund. C. Reinvesting dividends in a fund. D. Selling units systematically. Answer. The term systematic investment plan, SIP, refers to B. Investing a fixed amount periodically in a mutual fund. Explanation. SIP defined, a systematic investment plan, SIP, allows investors to invest a predetermined amount of money at regular intervals, such as monthly or quarterly, into a mutual fund. This approach helps in averaging the cost of investment over time and encourages disciplined saving. It is particularly beneficial for investors who prefer to invest smaller amounts regularly rather than making a large one-time investment. Other options. A. One-time investment in a mutual fund. This describes a lump sum investment, not SIP. C. Reinvesting dividends in a fund. This is known as a dividend reinvestment plan, which is different from SIP. D. Selling units systematically. This does not describe SIP, it relates more to systematic withdrawal plans. Therefore, the correct answer is B. Investing a fixed amount periodically in a mutual fund. 12. Which type of mutual fund is designed to replicate the performance of a specific stock market index? A. Sector fund. B. Index fund. C. Balanced fund. D. Arbitrage fund. Answer. The type of mutual fund designed to replicate the performance of a specific stock market index is B. Index fund. Explanation. Index funds. These funds are structured to mirror the performance of a particular market index, such as the S&P 500 or Nifty 50. They achieve this by investing in the same securities that comprise the index in the same proportions. This passive investment strategy aims to provide investors with returns that closely match those of the index being tracked, offering broad market exposure and diversification at a relatively low cost. Other options. A. Sector fund. These focus on specific sectors of the economy rather than tracking an index. C. Balanced fund. These invest in a mix of equities and fixed income securities but do not specifically track an index. D. Arbitrage fund. These seek to profit from price discrepancies in different markets and do not aim to replicate an index. Therefore, the correct answer is B. Index fund. 13. The expense ratio of a mutual fund measures A. The returns earned by the fund. B. The efficiency of fund management. C. The annual operating expenses of the fund as a percentage of average assets. D. The commission paid to distributors. Answer. The expense ratio of a mutual fund measures C. The annual operating expenses of the fund as a percentage of average assets. Explanation. Expense ratio defined. The expense ratio reflects the total annual operating expenses incurred by the mutual fund, including management fees, administrative costs, and other expenses, expressed as a percentage of the fund's average assets under management, AUM. A lower expense ratio indicates that a larger portion of the fund's returns is being passed on to investors, while a higher ratio may erode returns over time. Other options. A. The returns earned by the fund. This is not what the expense ratio measures, it focuses on costs rather than returns. B. The efficiency of fund management. While a lower expense ratio can indicate more efficient management, the ratio itself specifically quantifies expenses, not efficiency directly. D. The commission paid to distributors. While commissions can be part of the expenses included in the expense ratio, it does not solely measure distributor commissions. Therefore, the correct answer is C. The annual operating expenses of the fund as a percentage of average assets. 14. The lock-in period for a mutual fund typically applies to A. Equity funds. B. Balanced funds. C. ELSS funds. D. Liquid funds. Answer. The lock-in period for a mutual fund typically applies to C. ELSS funds. Explanation. ELSS funds, equity-linked savings schemes (ELSS), are a type of mutual fund that specifically includes a lock-in period of 3 years. During this time, investors cannot redeem or sell their units, which encourages long-term investment and provides tax benefits under Section 80C of the Income Tax Act in India. Other options. A. Equity funds. Not all equity funds have a lock-in period, most are open-ended. B. Balanced funds. Similar to equity funds, balanced funds generally do not have a lock-in period. D. Liquid funds. These funds are designed for short-term investments and do not impose a lock-in period. Therefore, the correct answer is C. ELSS funds. 15. Mutual funds in India are regulated by A. RBI, B. SEBI, C. AMFI, D. Ministry of Finance. Answer. Mutual funds in India are regulated by B. SEBI. Explanation. Securities and Exchange Board of India, SEBI. SEBI is the primary regulatory authority overseeing the mutual fund industry in India. It is responsible for formulating regulations, ensuring investor protection, maintaining market integrity, and promoting transparency in mutual fund operations. SEBI's regulations cover various aspects, including the establishment, management, and performance of mutual funds, as well as the conduct of asset management companies, AMCs. Therefore, the correct answer is B. SEBI. 16. In a no-load mutual fund, A. Investors do not pay an entry or exit load. B. The fund does not charge an expense ratio. C. The fund does not invest in equity instruments. D. Dividends are not distributed. Answer. In a no-load mutual fund, A. Investors do not pay an entry or exit load. Explanation. No-load funds. These mutual funds do not charge any sales fees, also known as loads, when investors buy or sell shares. This means that both entry, purchase, and exit, redemption, transactions are free of these additional costs, allowing investors to invest the full amount without deductions for commissions. However, it's important to note that no-load funds may still have other fees, such as annual management fees or redemption fees under certain conditions. Other options. B. The fund does not charge an expense ratio. This is incorrect. No-load funds can still charge an expense ratio for management and operational costs. C. The fund does not invest in equity instruments. No-load funds can invest in various asset classes, including equities. D. Dividends are not distributed. No-load funds can distribute dividends. Their classification as no-load pertains only to sales charges. Therefore, the correct answer is A. Investors do not pay an entry or exit load. 17. Which of the following is a feature of a balanced mutual fund? A. Investments in equities only. B. Investments in a mix of equities and debt instruments. C. Guarantees fixed returns. D. Focuses only on a specific sector. Answer. The feature of a balanced mutual fund is B. Investments in a mix of equities and debt instruments. Explanation. Balanced mutual funds. These funds are designed to provide a combination of capital appreciation and income by investing in both equities, stocks, and fixed income securities, bonds. The typical allocation can vary, but balanced funds generally maintain a predetermined ratio between equity and debt, allowing investors to benefit from the growth potential of stocks while also enjoying the stability and income provided by bonds. This diversification helps to manage risk while aiming for overall portfolio growth. Other options. A. Investments in equities only. This is incorrect, as balanced funds specifically include both equities and debt. C. Guarantees fixed returns. Balanced funds do not guarantee fixed returns. Their performance depends on market conditions. D. Focuses only on a specific sector. This is also incorrect, as balanced funds invest across various sectors through their equity and debt components. Therefore, the correct answer is B. Investments in a mix of equities and debt instruments. 18. What is the purpose of the Securities Transaction Tax, STT, in mutual funds? A. To encourage long-term investments. B. To regulate tax benefits for investors. C. To tax profits from the sale of mutual fund units. D. To penalize early withdrawals. Answer. The purpose of the Securities Transaction Tax, STT, in mutual funds is C. To tax profits from the sale of mutual fund units. Explanation. Securities Transaction Tax, STT. This tax is levied on the sale of units of equity-oriented mutual funds when traded on recognized stock exchanges. It applies regardless of whether the investor has made a profit or incurred a loss in the transaction. The STT is a form of turnover tax, meaning it is based on the total transaction value rather than just the profits made from the investment. This helps to regulate trading activities and serves as a source of revenue for the government. Other options. A. To encourage long-term investments. While STT can impact trading behavior, its primary function is not to encourage long-term investments. B. To regulate tax benefits for investors. STT does not specifically regulate tax benefits, it is a transactional tax. D. To penalize early withdrawals. STT is not designed as a penalty mechanism for early withdrawals. Therefore, the correct answer is C. To tax profits from the sale of mutual fund units. 19. Which of the following can impact the NAV of a mutual fund? A. Fluctuations in the value of securities held in the portfolio. B. Changes in the expense ratio. C. Redemption of units by investors. D. All of the above. Answer. The correct answer is D. All of the above. Explanation. A. Fluctuations in the value of securities held in the portfolio. The NAV of a mutual fund is directly affected by the market value of the securities it holds. If the prices of these securities increase or decrease, the NAV will reflect those changes. B. Changes in the expense ratio. The expense ratio impacts the overall returns of the fund. A higher expense ratio means that a larger portion of the fund's assets is consumed by expenses, which can lead to a lower NAV. C. Redemption of units by investors. When investors redeem their units, it can affect the total assets of the fund. If a significant number of units are redeemed, it may lead to a decrease in NAV, especially if the fund has to sell securities to meet redemption requests. Since all these factors can influence the NAV of a mutual fund, the correct answer is D. All of the above. 20. Which of these terms refers to periodic payouts by a mutual fund scheme? A. Systematic investment plan. B. Dividend payout. C. Capital gain distribution. D. Redemption. Answer. The term that refers to periodic payouts by a mutual fund scheme is B. Dividend payout. Explanation. Dividend payout. This refers to the distribution of a portion of the mutual fund's earnings to its investors at regular intervals, which can occur quarterly, semi-annually, or annually. These payouts represent the fund's profits generated from its investments, including dividends from stocks and interest from bonds. Investors can choose to receive these dividends in cash or reinvest them in additional units of the fund. Other options. A. Systematic investment plan. This is a method of investing a fixed amount regularly, not related to payouts. C. Capital gain distribution. This refers to the distribution of profits realized from selling securities within the fund, but it is not specifically termed as periodic payouts like dividends. D. Redemption. This refers to the process of selling units back to the fund, not a periodic payout. Therefore, the correct answer is B. Dividend payout. 21. The primary objective of a growth fund is A. Capital preservation. B. High dividend income. C. Long-term capital appreciation. D. Tax savings. Answer. The primary objective of a growth fund is C. Long-term capital appreciation. Explanation. Growth funds. These mutual funds focus on investing in companies that are expected to experience significant growth in earnings and revenue over time. The main goal is to achieve capital appreciation rather than generating income through dividends. Growth funds typically invest in stocks of companies that reinvest their profits for expansion and development, aiming for substantial returns over the long term. Investors in growth funds are generally looking for higher potential returns, which often come with increased risk. Therefore, the correct answer is C. Long-term capital appreciation. 22. A liquid fund is ideal for A. Long-term wealth creation. B. Short-term parking of surplus funds. C. Investing in equity instruments. D. High-risk investors. Answer. A liquid fund is ideal for B. Short-term parking of surplus funds. Explanation. Liquid funds. These are a type of mutual fund that invests in short-term debt instruments and money market securities with maturities of up to 91 days. They are designed to provide investors with a safe and easily accessible option for parking surplus funds while earning a better return than a traditional savings account. Liquid funds offer high liquidity, allowing investors to withdraw their money quickly, usually within one business day. Other options. A. Long-term wealth creation. Liquid funds are not suitable for long-term investments as they focus on short-term returns. C. Investing in equity instruments. Liquid funds do not invest in equities, they focus on fixed income securities. D. High-risk investors. Liquid funds are generally low-risk investments, making them suitable for conservative investors rather than high-risk ones. Therefore, the correct answer is B. Short-term parking of surplus funds. 23. Who appoints the trustees of a mutual fund? A. SEBI. B. The sponsor. C. The AMC. D. AMFI. Answer. The trustees of a mutual fund are appointed by B. The sponsor. Explanation. Sponsor's role. The sponsor of a mutual fund is responsible for appointing the board of trustees or a trustee company that will oversee the mutual fund's operations. While the appointment is subject to regulatory approval from SEBI, Securities and Exchange Board of India, it is ultimately the sponsor who initiates the appointment process. The trustees have a fiduciary duty to protect the interests of the investors and ensure compliance with applicable regulations. Therefore, the correct answer is B. The sponsor. 24. What is the purpose of a fund of funds, FOF? A. To invest in a mix of debt and equity instruments. B. To invest in other mutual fund schemes. C. To provide tax benefits. D. To guarantee capital protection. Answer. The purpose of a fund of funds, FOF, is B. To invest in other mutual fund schemes. Explanation. Fund of funds, FOF. A fund of funds is an investment vehicle that pools capital from investors to invest in a diversified portfolio of other mutual funds rather than directly investing in individual stocks or bonds. This strategy allows investors to achieve diversification and access professional management across multiple funds, simplifying the investment process while spreading risk. Other options. A. To invest in a mix of debt and equity instruments. While FOFs can invest in funds that hold both debt and equity, their primary purpose is to invest in other mutual fund schemes. C. To provide tax benefits. FOFs do not inherently provide tax benefits, their tax treatment depends on the underlying funds they invest in. D. To guarantee capital protection. FOFs do not guarantee capital protection as they are subject to market risks based on the performance of the underlying funds. Therefore, the correct answer is B. To invest in other mutual fund schemes. 25. What is an important feature of a thematic fund? A. It invests in a specific theme or sector. B. It guarantees fixed returns. C. It is risk-free. D. It invests only in debt instruments. Answer. An important feature of a thematic fund is A. It invests in a specific theme or sector. Explanation. Thematic funds. These mutual funds focus on investing in companies that are related to a particular theme or trend, which can span multiple sectors. For example, a thematic fund might target themes such as renewable energy, technology disruption, or healthcare innovations. Unlike sector funds, which concentrate on a single industry, thematic funds provide exposure to various sectors that align with the chosen theme. Therefore, the correct answer is A. It invests in a specific theme or sector. 26. In the context of mutual funds, what does redemption mean? A. Selling units back to the mutual fund. B. Buying units from the mutual fund. C. Reinvesting dividends into the scheme. D. Switching between different mutual fund schemes. Answer. In the context of mutual funds, redemption means A. Selling units back to the mutual fund. Explanation. Redemption defined. Redemption refers to the process by which an investor sells their mutual fund units back to the asset management company, AMC. This allows the investor to convert their investment into cash based on the current net asset value, NAV, of the fund. Investors can choose to redeem either a portion of their investment or the entire amount, depending on their financial needs. Other options. B. Buying units from the mutual fund. This describes the purchase process, not redemption. C. Reinvesting dividends into the scheme. This is known as dividend reinvestment, which is different from redemption. D. Switching between different mutual fund schemes. This is referred to as switching and is not the same as redemption. Therefore, the correct answer is A. Selling units back to the mutual fund. 27. What is a characteristic of a gilt fund? A. Investments in equities of government-backed companies. B. Investments only in government securities. C. High-risk investments in small-cap stocks. D. Guaranteed returns. Answer. A characteristic of a gilt fund is B. Investments only in government securities. Explanation. Gilt funds. These mutual funds primarily invest in government-issued securities, such as government bonds and treasury bills. Because they are backed by the government, gilt funds are considered low-risk investments, making them suitable for conservative investors seeking stable returns. The focus on government securities ensures minimal credit risk compared to other types of funds that may invest in corporate bonds or equities. Therefore, the correct answer is B, investments only in government securities. 28. What is the maximum expense ratio allowed for a debt mutual fund in India? A. 2%. B. 2.25%. C. 2.50%. D. 3%. Answer. The maximum expense ratio allowed for a debt mutual fund in India is B. 2.00%. Explanation. According to the regulations set by the Securities and Exchange Board of India, SEBI, for debt mutual funds with assets under management, AUM, up to 500 crore, the maximum expense ratio that can be charged is 2.00%. For AUM between 501 crore and 750 crore, the maximum expense ratio is reduced to 1.75%. Therefore, the correct answer is B, 2.00%. 29. The primary role of Mfd is to A. Regulate mutual funds. B. Safeguard the interests of investors. C. Promote mutual funds in India. D. Monitor SEBI guidelines. Answer. The primary role of Mfd is to C. Promote mutual funds in India. Explanation. Association of Mutual Funds in India, AMFI, Mfd is a self-regulatory organization established to promote and develop the mutual fund industry in India. Its key functions include enhancing investor education, ensuring transparency in the mutual fund market, and fostering ethical practices among asset management companies. While Mfd also works to safeguard investor interests and maintain standards within the industry, its primary focus is on promoting mutual funds and increasing awareness among potential investors. Therefore, the correct answer is C, promote mutual funds in India. 30. Which type of fund primarily invests in companies of a particular size, such as small cap or mid cap? A. Index fund. B. Sector fund. C. Capitalization-based fund. D. Arbitrage fund. Answer. The type of fund that primarily invests in companies of a particular size, such as small cap or mid cap, is C. Capitalization-based fund. Explanation. Capitalization-based funds. These funds are categorized based on the market capitalization of the companies they invest in. They can focus specifically on small cap, mid cap, or large cap companies, allowing investors to target specific segments of the market according to their risk appetite and investment goals. This classification helps investors identify opportunities across different company sizes, each with distinct risk and return profiles. Therefore, the correct answer is C, capitalization-based fund. 31. The cutoff timing for mutual fund transactions affects A. Dividend payouts. B. NAV applicable for purchases or redemptions. C. Taxability of the investment. D. Expense ratio of the fund. Answer. The cutoff timing for mutual fund transactions affects B. NAV applicable for purchases or redemptions. Explanation. Cutoff timing impact. The cutoff time determines which day's net asset value, NAV, will be applied to mutual fund transactions. If a transaction, purchase or redemption, is submitted before the cutoff time, it is processed at that day's NAV. Transactions submitted after the cutoff time are processed at the next business day's NAV. This mechanism ensures fairness and transparency in mutual fund operations, allowing investors to understand the timing's impact on their investment value. Therefore, the correct answer is B, NAV applicable for purchases or redemptions. 32. The settlement period for mutual fund redemptions in India is typically A. D+1. B. D+2. C. D+3. D. D+5. Answer. The settlement period for mutual fund redemptions in India is typically B. D+2. Explanation. According to the information available, the settlement for mutual fund redemptions can vary depending on the type of fund. However, many mutual funds generally settle on a D+1 or D+2 basis. Specifically, for equity funds, the settlement can occur on T+1 or T+2 days, while debt funds may also follow similar timelines. The T+2 settlement means that the redemption proceeds are credited to the investor's account within 2 business days after the redemption request is processed. Therefore, the correct answer is B, D+2. 33. A high turnover ratio in a mutual fund indicates A. Frequent buying and selling of securities in the portfolio. B. Higher expense ratios. C. Low liquidity. D. Better fund performance. Answer. A high turnover ratio in a mutual fund indicates A. Frequent buying and selling of securities in the portfolio. Explanation. Turnover ratio defined. The turnover ratio measures how frequently assets within a mutual fund are bought and sold over a specific period, typically 1 year. A high turnover ratio signifies that the fund manager is actively trading, frequently changing the portfolio holdings to capitalize on market movements or other opportunities. This can lead to increased transaction costs, which may impact the overall returns of the fund. Therefore, the correct answer is A. Frequent buying and selling of securities in the portfolio. 34. Who is responsible for the safe custody of mutual fund assets? A. SEBI. B. Custodian. C. Trustees. D. AMC. Answer. The entity responsible for the safe custody of mutual fund assets is B. Custodian. Explanation. Custodian's role. A custodian is a financial institution, typically a bank or trust company, that holds and safeguards the securities and assets of a mutual fund. The custodian ensures the safety and proper management of the fund's assets, providing a layer of security against potential fraud or mismanagement. Their responsibilities include maintaining accurate records of the fund's holdings, executing trade settlements, and ensuring compliance with regulatory requirements. Therefore, the correct answer is B. Custodian. 35. What does the term risk-adjusted return mean in mutual funds? A. Return after deducting taxes. B. Return relative to the risk taken. C. Absolute returns earned by the fund. D. Guaranteed returns. Answer. The term risk-adjusted return in mutual funds means B. Return relative to the risk taken. Explanation. Risk-adjusted return defined. Risk-adjusted return is a measure that evaluates the profitability of an investment by considering the level of risk associated with it. This metric allows investors to compare different investments on a more equitable basis, as it takes into account not just the returns generated but also the risks taken to achieve those returns. Higher risk-adjusted returns indicate that an investment has generated more return per unit of risk, which is generally seen as favorable for investors looking to maximize their gains while managing risk effectively. Therefore, the correct answer is B. Return relative to the risk taken. 36. Which of the following is true of equity mutual funds? A. They are risk-free. B. They guarantee returns. C. They provide capital growth over the long term. D. They only invest in large-cap stocks. Answer. The statement that is true of equity mutual funds is C. They provide capital growth over the long term. Explanation. Capital growth. Equity mutual funds primarily invest in stocks, which have the potential for significant capital appreciation over time. These funds are designed for investors looking to grow their wealth by participating in the equity markets, which typically offer higher returns compared to fixed income investments over the long term. While equity mutual funds come with risks due to market volatility, they are generally considered suitable for long-term investment horizons aimed at capital growth. Other options. A. They are risk-free. This is incorrect. Equity mutual funds carry market risk and are not risk-free. B. They guarantee returns. Equity mutual funds do not guarantee returns, their performance depends on market conditions. D. They only invest in large-cap stocks. This is also incorrect. Equity mutual funds can invest in small-cap, mid-cap, and large-cap stocks, depending on their investment strategy. Therefore, the correct answer is C. They provide capital growth over the long term. 37. Arbitrage funds capitalize on A. Long-term growth opportunities. B. Differences in prices between markets or securities. C. Fixed income securities. D. Investments in international stocks. Answer. Arbitrage funds capitalize on B. Differences in prices between markets or securities. Explanation. Arbitrage funds. These mutual funds exploit price discrepancies that exist between different markets, such as the cash, spot, market and the futures market. By simultaneously buying a security in one market at a lower price and selling it in another market at a higher price, arbitrage funds aim to generate profits from these price differentials. This strategy allows them to take advantage of temporary inefficiencies in the market while maintaining a relatively low risk profile. Therefore, the correct answer is B. Differences in prices between markets or securities. 38. What does the term liquidity refer to in mutual funds? A. The risk associated with the fund. B. The ability to convert investments into cash quickly. C. The overall expense ratio. D. The long-term growth potential. Answer. The term liquidity in mutual funds refers to B. The ability to convert investments into cash quickly. Explanation. Liquidity defined. In the context of mutual funds, liquidity indicates how easily and quickly an investor can convert their mutual fund units into cash without significantly affecting the price. High liquidity means that investors can redeem their units and receive their cash proceeds promptly, typically within a few business days. This is an important consideration for investors who may need access to their funds on short notice. Therefore, the correct answer is B. The ability to convert investments into cash quickly. 39. Which of these is an advantage of investing in mutual funds? A. Guaranteed returns. B. Professional fund management. C. No market-related risks. D. Tax-free returns. Answer. The advantage of investing in mutual funds is B. Professional fund management. Explanation. Professional fund management. One of the key benefits of mutual funds is that they are managed by professional fund managers who have the expertise and resources to make informed investment decisions. This allows investors, who may not have the time or knowledge to manage their investments effectively, to benefit from the skills of experienced professionals. The fund managers actively monitor and adjust the portfolio to align with the fund's objectives, aiming to optimize returns while managing risk. Other options. A. Guaranteed returns. Mutual funds do not guarantee returns, they are subject to market risks. C. No market-related risks. All investments in mutual funds carry some level of market risk. D. Tax-free returns. While certain mutual fund investments may offer tax benefits, like ELSS, not all mutual funds provide tax-free returns. Therefore, the correct answer is B. Professional fund management. 40. What is the minimum application amount for an ELSS fund in India? A. 500 rupees. B. 1000 rupees. C. 5000 rupees. D. 10,000 rupees. Answer. The minimum application amount for an ELSS, equity-linked savings scheme, fund in India is A. 500 rupees. Explanation. Most ELSS schemes allow investors to start investing with a minimum amount of 500 rupees, whether through a lump sum investment or a systematic investment plan, SIP. This low entry threshold makes it accessible for a wide range of investors looking to benefit from tax-saving investments while participating in the equity market. Therefore, the correct answer is A. 500 rupees.